Hello and welcome to the Retirement Planning Podcast, your trusted source for navigating the path to a secure retirement. Your host and guide on this journey towards financial peace of mind is Darrin and On this show, we'll delve into everything you need to know about retirement planning, from investment strategies and risk management to maximizing your Social Security benefits and crafting a resilient financial plan using the bucket plan financial process. Join me as we bring you insights from top financial experts, share stories of successful retirement journeys, and provide practical tips to help you build and preserve your wealth. Let's embark on this adventure together as we strive towards a future where retirement isn't just a dream, but a well-planned reality.
Hey everyone, welcome to the Retirement Planning Podcast. This is Season 2, Episode 1. My name is Darrin McComas. I'm a financial advisor here at Evergreen Wealth Advisors, and
I'm Jason Fox. I'm also an advisor here at the firm.
Yeah, today's episode really is looking at, we're heading into 2026. We're looking at different strategies. So I've seen recently there was a Vanguard article that came out. We'll get into that, but this is kind of looking at the bucket plan system versus some different strategies such as like the 60-40, or the all or nothing strategy, right? We're either all in equities or we're all out of equities and sitting in cash, and kind of talking about the pros and cons of all these different strategies and why we really prefer the bucket plan strategy. It's 2026. Today's January 9th.
Right.
I'm sure everyone's made their New Year's resolutions and 9 days into the year, hopefully they're still on track. I saw this funny meme the other day about these gyms, right? Offering 2-week memberships. Because
2 weeks, wow.
That's about the average length of, people sign up for a new gym membership. And of course, after about 2 weeks,
right there.
they're done and they're back on their couch. But hopefully that's not you. But, if 2026 is the year that you're retiring, or it's just right around the corner, maybe a year or two down the road, I think you'll really enjoy today's episode. And, also a lot of people have been putting off getting that estate planning done.
Sure.
Talking about trusts and wills. And maybe this is the year you finally just get a real financial plan in place.
Right.
Because you feel like you have investments, but you don't really have an income plan or a tax plan, or how does it all work together with Social Security and Medicare? Hopefully our podcast is a great resource for you to be educated on some things you should definitely be thinking about. All right. With January 9th, if you look at the market,
yes,
right, intraday, we're sitting at all-time highs in the market. Some pundits out there are saying the Dow is going to hit 60,000 this year. And then on the other hand, we have some analysts that are calling for the end of the world, right? And the market's going to crash.
Depends on who you're listening to, right?
It definitely depends on who you listen to. And I just have to caution people when they're watching the various channels out there and social media, sensationalism sells, right? You need clicks, you need followers, you need viewers.
Right.
Be careful.
Yeah. Well, make sure what you're watching isn't entertainment, right?
Yeah.
And that whatever analysis is being used is based off of facts and numbers and not emotion. Right.
Data over emotions or gut feelings or what's going to get them the most clicks.
Yeah. The market does not care what our emotions are regarding what it's doing. It cares about what's going on in the economy and the numbers, right?
Absolutely. Well, recently, just at the very end of the year, I think it was December 30th, Vanguard published this article, and one of their heads of portfolio construction stated that they're moving out of the 60-40 kind of traditional portfolio model and going into a 40-60 weighting, 40% stocks, 60% bonds. And we have the link to that article if you want to check it out. But this has created all sorts of discussions on social media platforms like Reddit and Facebook, as well as some media outlets have picked up on it. And a lot of people are, why would a huge, massive company like Vanguard come out with this call of shifting more out of stocks and into safer kind of assets like bonds? So I guess one could only guess, but I would imagine that they're maybe seeing some market volatility ahead for the year or maybe for the next several years. And if you are retired, we always talk about this, or getting close to retirement and that sequence of return risk. So
Sure.
Jason, you want to hit on that real quick?
Well, on the sequence of return risk specifically, that's basically if you are invested the way you probably were throughout your career, which is typically more aggressive, that means that you're mostly in equities. Now, the reason that becomes a concern is because as you move into retirement and you start to pull money out of your retirement accounts, if you're all in equities, that means you are subject to the sequence of returns risk, because if the market drops and you're pulling that money out, then what you used to be able to sell 100 shares in order to raise X number of dollars. Now you have to sell 200 shares in order to raise the same amount of money. And so your assets depreciate faster as a result of the market being down. When you're in that accumulation phase, doesn't necessarily matter. You just wait it out. You keep adding to it. You lower your cost basis, all of that, right? But in retirement, when you're pulling it out, if you're not protecting yourself from the very real possibility that the market will go down at some point within the context of your retirement, it's something you should be thinking about, or at least we believe that, right?
Absolutely. So sequence of return risk, we've talked about it on other episodes, but it's a real risk. It's probably, to me, it's one of the highest risks for people who are getting close to retirement or just entered retirement, because it can devastate you if you get caught in like a 2008 style market crash early in retirement while you're taking those distributions.
Right.
So, in today's episode, we're going to talk about, does it make sense to follow the crowd, right? And do these kind of cookie cutter strategies such as, when you retire, put all your money in a 60-40 kind of portfolio, 60% stocks, 40% bonds, set it, forget it, sail off into retirement and live happily ever after. Or, we've even heard some people out there going 100% into equities or 100% into bonds or money markets or CDs or just sitting in cash because they're afraid the sky is falling.
Yeah, and they're trying to time the market, essentially, right?
Yeah. Or is there a better way? And, we use the bucket plan system, which we'll go into here in a small amount of detail. We have other episodes where we go a lot more detail in the bucket plan, but that's our preferred method. It's about getting diversified, right? Versus putting all your eggs in one basket. So if you're watching this on YouTube, we'll put this graphic up here of the bucket plan system. And really it's about spreading your wealth, your hard-earned retirement savings into 3 different buckets based on different time horizons. And this is that diversification that can protect you against that sequence of return risk. And it's the now bucket. Your now bucket is there for income for the next 12 months, really, is how we design it. It needs to be safe. It needs to be liquid. If the market crashes, we don't have to worry about that bucket of money getting caught in a market decline and having to change our lifestyle abruptly. And it could also mean emergency money or comfort funds or just planned expenses if you need to buy a new car in this particular year, or you want to go on vacation. Let's carve that out. Let's keep it safe. Let's keep it liquid. It could be sitting in cash in your bank account. It could be invested in a 6 or 12-month CD,
right?
Or a money market fund, something safe, something you can get to at a moment's notice. And then if we look at that soon bucket, this is really the secret sauce that makes our bucketing system different than others. Our time horizon on the soon bucket is 1 to 10 years out in time. We're filling that up, making sure we account for things like required minimum distributions.
Yes.
If you were born before 1960 and you have a lot of IRA money or 401k money, the government's going to come after that pre-tax money at your RMD age. And that if you're born before 1960, most likely that is 73. If you're born after 1960, we're talking, they bump that out a few years and now your first RMD will be around age 75. So that soon bucket, we're accounting for, the next 10 years, how much are you going to be forced to pull out in those required minimum distributions? How much additional are you going to need for just income?
Right.
And we're going to gross that up for taxes, both at the state and federal level, and make sure we have plenty of money in that soon bucket that's invested more conservatively.
Right. Yeah. The idea there is to make sure that you're not having to stress out about what the market is doing. It is not only is it buying you a time horizon, it's buying you peace of mind because it allows you to kind of get the best of both worlds in terms of that security as well as that long-term growth, which kind of takes us into the later bucket, right?
Absolutely. And there's a bunch of different tools we can use in that soon bucket, depending on, your risk appetite and your, what you like. Some of our clients, their soon bucket is more of a 40-60 kind of portfolio, or 20-80, more bonds in that portfolio. Other clients love to use buffered ETFs or fixed index annuities. Others use a laddered bond system, where we have various bonds maturing at different dates. There's a lot of ways to construct that soon bucket. We kind of come into that agnostic and
absolutely
really let the clients weigh in on how they want that soon bucket crafted. Of course, giving them the highest chance at success.
Yeah, and I think to your point, what it really comes down to is that yes, we're using the bucket plan as a framework, but that doesn't mean that we're doing something that's cookie cutter.
Exactly.
Right? It is very highly personalized to each one of our clients because each one of their situations is highly nuanced, right?
Absolutely. And some people, it really comes down to what's their withdrawal rate, how much, income do they need?
Do they have an income gap, right? There's so many different variables for us to look at.
Yeah. So under the hood, it gets a little more complicated, but we have lots of tools to use to build that soon bucket. And then that later bucket, like you were saying, that's for money we won't need to touch for 10 or more years in time. Now, if that money is invested more growth oriented and gets caught in a market decline, market crash, we know that we're never going to be forced to sell assets out of that and mark a permanent loss on those positions, which would be devastating. We have time because we have that now and soon bucket in place to ride out any storm that the market throws at us. And eventually the recovery does come in those accounts. If you stick with it, usually over a decade more of time horizon, come out way ahead.
Yeah, absolutely. And, on average, the average recovery takes roughly 2 to 3 years.
Yeah.
And so that's why we're looking at that 10-year time frame. Even if we've kind of used the resources that are in that soon bucket, maybe we've got, 5 years left, we still have plenty of time to wait for that recovery and pick an optimal time to kind of waterfall the necessary resources back into that soon bucket.
Yeah, it gives us some flexibility. We're going to, refill that soon bucket from the later bucket. Well, let's compare and contrast that bucket plan system, which really does get you diversified across different time horizons. You have diversification within each bucket and what you're invested in, versus just what some people out there love is the all in or all out, right? Like the hokey pokey dance here. Right. So the 100% strategy of and we're going to put this graphic up on YouTube. Usually when the market's ripping, it's sitting at all-time highs. People start to get greedy. They want to buy more. They want to, sell some of their safer assets and move it into crypto like Bitcoin, or, find the latest tech stock AI thing they saw on TV. And then of course markets do what they do. They cycle. And if you got in at the top and you have a decline, 20, 30%, 40%, then that fear starts to kick in on that descent, and you go to the opposite strategy where you're all out. You can't stomach it at some point, or and then you rinse and repeat this after a few years, and it's a great recipe to go broke in retirement.
Yes.
So this is not diversification, all in, all out. We see it with some of our clients that want to kind of get into this emotional roller coaster, and we have to coach them through it. Stick with the bucket plan strategy. You have that layer bucket out there where you're going to get that good growth, but putting all your eggs in one basket and then getting caught off sides when the market doesn't work your way, it can be disastrous.
Absolutely.
Then I want to hit this article from Vanguard, right? And we have the link in the show notes there if you want to check that article out. But oftentimes when people come meet with us, whether that's from an educational seminar or they just find us online and visit with us, they tend to have portfolios that are very cookie cutter.
Right.
They're in a 60-40 portfolio, and their whole retirement account is in that one model.
Right.
And I think we saw definitely in 2022 that did not work out so well, that traditional 60-40 model.
Right. At that time, equities and bonds both were going down.
Yeah. And Vanguard, on December 30th of 2025, released this article about shifting their 60-40 into a more 40-60 model, getting even more conservative if you're a retiree. And, that's, to me, that also is a big risk when you have just one portfolio model for all your savings.
Right.
Because what if we have another scenario where inflation's sticky, heaven forbid, we keep printing money in the United States and interest rates creep higher. Well,
right.
How bonds work, when interest rates go up, bond prices go down, as you see in this graphic here. And that's exactly what happened right after COVID.
Right.
You had all this printing and stimulus packages that were rolled out, and all this money was just thrust into the U.S. economy. And eventually, things started to get more expensive. Some of that was supply chain issues, obviously, but as it did, the bond market did start to see that, and interest rates rose dramatically. The Fed rose rates at an unprecedented rate, and bonds absolutely got clobbered during that period of time. And this is a case where just having one cookie cutter portfolio, like a 60-40 or 40-60 with all of your money, puts it at risk. If we look at, here's the AGG, the ticker symbol is AGG. It's the iShares Core U.S. Aggregate Bond ETF. One of the biggest ETFs in the world, has billions of dollars of assets under management. If you look at how it's done the last 5 years, from January 1st, 2021 to January 1st of 26, it's down 15%.
Right.
And if that's where you're drawing your income from and having to take a portion of your RMDs from,
right,
a minus 15 with inflation as high as it is today, I think that's really going to come under pressure if that's your retirement plan.
Absolutely. That is not a position you want to be in. We're not necessarily, when we look at that conservative portion of your portfolio, we're not necessarily trying to hit home runs or anything like that, but we're definitely not putting you in a position where you're going to be experiencing a negative 15 or, with inflation factored in, negative 20% in terms of your retirement account. That is just unsustainable, to say the least.
People ask me what scares you the most. I think 2022, a prolonged 2022, where we're talking 3, 4, 5 years of high inflation, severe market volatility, where we saw both stocks and bonds collapsing at the same time. That's a scenario that scares me the most. And could we have another lost decade like we had from 2000 to 2010?
I certainly hope not, but ruling it out seems foolish, right?
Right. So I hope today, in today's episode, when you're thinking about retirement and that paycheck is no longer there and you're now relying on your assets, whether that's a 401k or IRA or brokerage accounts, when you need cash, you're going to have to liquidate some of those positions to raise the cash and put it in your checking or savings account to live off of and maintain your lifestyle. And even if you don't need that, maybe you have a pension and your Social Security and that covers most of your, if not all of your living expenses. At some point, right, Jason, those required minimum distributions are going to kick in.
They absolutely will.
And you'll be forced to take positions, and you'll have to sell, and you'll have to raise that cash and take that money for income to satisfy those required minimum distributions, pay the IRS their due. And when you're forced during a market correction and when market volatility returns, it can be pretty painful. So that's why the bucket plan system, I think, really accounts for those things, right? If we know we're going to have to be forced to take that money out, let's plan for it.
Yeah. And I think that's what, the bucket plan is the foundation, but that's one of the things that sets us apart in this office from some of the stories we hear, at least in other offices, is the level of planning that we do. We're not suggesting that other offices don't plan, but we are suggesting that we dig into it a little deeper, at least according to some of the feedback that we get. And we're accounting for the sequence of returns risk. We're accounting for taxes. We're accounting for, long-term care insurance, all of these different things that we're looking at because, we know these things are coming, right? So why wouldn't we plan and make sure that we're going to get as good an outcome as we can, right? Let's optimize for retirement, not just, wing it.
Well, that brings up a real good point. The word holistic gets thrown around in our industry way too much. And every advisor out there is saying, well, we do holistic wealth management. But think about your advisor. Are they being proactive when it comes to tax planning? Are they being proactive when it comes to timing Social Security? Or are they talking to you about Medicare and looking at different plans? Are they talking to you about your estate plan? Does it line up with your accounts? Is everything titled correctly? Are your beneficiaries listed correctly? When's the last time you updated your trust or your will? Life's probably changed in the last 20 years for a lot of you. And when's the last time we've done a deep dive into your estate planning documents? All of these things, I think, come with that holistic wealth management. But
Absolutely.
Again, a lot of people talk the talk, but how many walk the walk? And I think that's something that we pride ourselves in. Is let's if we're going to praise ourselves as being holistic wealth management, we have to not only talk the talk, but walk the walk too.
Right.
All right. So again, think about this. What happens, where will you get your cash when that market volatility returns? And sometimes it's those RMDs.
Right.
Sometimes it's just we need money for income, but also life's unexpected events.
Right. 100%.
And life doesn't stop happening, right? You have one year you might have a major medical event, and how are you going to cover that? Maybe it's a lawsuit that you didn't, if you're a business owner, right? That you didn't anticipate, or a major home repair. You have a windstorm and the roof gets damaged, or a new car that you're going to need to buy. These are all things that crop up from time to time. At least what happens to our clients.
Absolutely.
And we got to account for that and expect that. And that's where that soon bucket sure comes in handy. Lastly here, I want to talk about a lot of people, when they retire, they never move their 401k, right? It just stays at the company and then they use that. That's their retirement plan, is their 401k. And I'd say that's not really a retirement plan. A lot of those are invested in target date funds. When you're working, a lot of these companies don't really give you a lot of advice. They can't legally give you financial advice on how to invest your 401k. A lot of people are just left to do it themselves. And, if this isn't your area of expertise, probably one of the easiest investments you can choose from the list that your 401k provides you is a target date fund.
Right.
I'm probably going to retire in the year 2025 or 2030. So you pick a date fund that matches that expected target retirement and set it and forget it. And a lot of people think that is a kind of a bulletproof way to, de-risk as you approach retirement. The goal with these target date funds, or at least how they're designed, is as you get closer and closer to that date, they're taking down the risk, right? They're lowering the equity positions and moving more into safer assets like bonds and cash or cash alternatives.
Right.
I will say this, not all target date funds are built the same.
No. Definitely.
And again, that is not a retirement income plan. That is not a tax strategy. That is a kind of cookie cutter and set it and forget it and cross your fingers and hope it works.
Yeah, exactly. It's the lazy person's way out. If I'm being honest, right? Because you can just set it and forget it, but it's definitely not optimized. Yeah. I know from experience in this office that if somebody comes in and they're in a target date fund and then we move them to our system, obviously it depends on how many resources they have, but we're significantly, outperforming that target date fund, right?
Yeah. I think we're de-risking them again, building out,
right.
different time horizons.
Because it's not just about the returns. If you're only looking at the returns, then you're missing all of those different things we just mentioned, when you talk about the estate planning, the taxes, et cetera, et cetera.
Absolutely. So if that's you, I think go talk to a financial advisor, the one that really does holistic wealth management. If that's all you have is your target date fund and you have a 401k and that's it, get some help. All right. Lastly here, we're going to put this graphic up on YouTube. It's, I call it the Trinity, right? This is what everyone wants. So on the top of the pyramid, it says high returns. On the bottom right of the pyramid, little to no risk. and on the bottom left of the pyramid, full liquidity. If there was ever an investment that was built that could do all three of these things well, I think we'd all probably have our money in it.
Well, then we would, but you do that set it and forget it thing,
Yeah,
right?
and you could, right?
But it doesn't exist.
Most of the times, you're lucky if you can get 2 out of the 3 of these.
Right.
You might get high returns and full liquidity,
Yeah.
but you're going to give up that little to no risk. If you're going for little to no risk because you're conservative and you want to have access to full liquidity where you can get your money out when needed, you're probably going to give up the potential for those higher returns. So, obviously, if we can do all 3 of these things well, that would be awesome in one tool. But as far as I know, it does not exist.
Right.
Now, you can achieve these 3 things.
Yes.
But you're not going to get, again, all 3 of them at the same time. And it's that.
And certainly not in one product, right? Like in one 60-40 portfolio or whatever. But if it's engineered properly, the plan, then you can achieve these things, which is what the bucket plan is, right?
Absolutely. Absolutely. So if you think, I think as soon as I see this triangle, I start to think about the bucket plan. I'm like, okay, little to no risk. That's our now bucket, and part of our soon bucket, full liquidity. Obviously, there's certain products out there that you don't have full liquidity, like annuities, even some CDs, 2 or 3 year CDs, don't have full liquidity without some consequences to them. So, and then the higher returns, that's, to me, obviously, we're looking at the later bucket strategy. Absolutely. So this is what everyone wants. It's just, you can get it. You just have to spread it out. You can be willing to, I guess, accept the cons to each one too.
Well, we always tell our clients, right? There is no perfect product. There are pros and cons to everything. And, if you're in our office, our job is to educate you on that and help walk you through that process, right? And then build the system according to those individual needs.
Absolutely. All right, we're going to wrap up today's episode. I think another layer to this cake, if we want to explain it that way, is your advisor helping you with taxes, right?
Right.
We hear this a lot, that holistic wealth piece. Part of that puzzle is tax planning. And I think we see it all the time when we hold these classes, people come in and talk to us. A lot of the reasons they end up switching to our firm is because their advisor is not helping them at all with any tax planning or tax management. And there's really 3 tax efficient funnels, as you can see on this graphic here. There's the pre-tax funnel. That's money funded, with your IRA, your 401k, even those pensions. Money, when you take it out of that funnel, it's taxed as ordinary income, right? Now you're subject to federal taxes as well as state and local taxes.
Right.
Then we have the middle funnel, the post-tax. That's your brokerage account, your bank account, even real estate that you own. When you take money out of those kinds of accounts, it's taxed as you're taxed just on the growth, right? The capital gains.
Right.
And then our favorite funnel is that tax advantage, right? That's your Roth IRA plans, your FSA or HSA and cash value life insurance. When you take distributions from those accounts, almost always that's tax-free money.
Right.
And so when we help build retirement plans, we're not only looking at their buckets, the now soon and later buckets, we're looking at these 3 different tax-efficient funnels. And we take our clients through these exercises. It's a little tic-tac-toe graphic here where on the top we're putting the bucket plans and then on the left we're putting the different tax funnels. And then we're seeing how much money do they currently have allocated to each one of those squares.
Right.
And a lot of times we see major gaps in this. And it's very eye-opening. It's a great exercise we do with prospective clients when they come in. It shows them that, gosh, I have way too much money out there in that later bucket or way too much money in that pre-tax funnel. I'm going to get clobbered when those RMDs kick in.
Yeah, absolutely. We see all kinds of different configurations of this, but one thing we almost never see is somebody who comes in and has all of the boxes kind of populated and filled out in a correct way. And so, over time, we're looking to, for those that work with us, we're looking to allocate those resources in the most optimal way to each of those different funnels. I oftentimes, everybody understands diversification and the importance of that. what I often tell clients is that we're looking at diversifying over 3 different areas. Of course, assets, which everybody knows about. Make sure you don't have all of your money in Apple. You need to diversify over the equities and the various assets that you own. But what people often don't know about is diversifying over time, which is the bucket plan. And then obviously the tax funnels that we just showed you, and diversifying over those as well. So looking at all 3 of those areas, it dramatically improves the plan over time when you do that.
We definitely feel that's the superior way to do planning. Well, thank you so much for sticking to the end of today's podcast episode. If you're entering 2026 and you just feel like you don't have a real income plan, and you're confused and your advisor isn't being proactive, or maybe you're just trying to do this by yourself, book that complimentary strategy session with us. You'll either get on the phone with Jason or myself, and we'll just take a look at your current situation and see if there's any value that we could add, or any tips or recommendations that, we can legally provide you and point you in the right direction. But I think, again, holistic wealth management, that holistic word gets thrown around a lot, but are you really getting everything that you should from your advisor? And if you're doing it by yourself, that's a hard road in retirement, because things are always changing. New legislation is always cropping up that you may not hear about, that may affect what you're doing. So I always say, hire a great advisor, whether call us or find a good fiduciary right next to where you live,
right,
if you prefer that face-to-face. But if you want to know more about our bucket plan system and how it works, you can download a free guide on our website. We have a white paper called the Bucket Plan Philosophy, and our website is ewadvisors.com. We'll flash that up there on the screen, and we'll have a link to that in our show notes. But, the bucket plan has been around for a while. Bucketing's been around.
Right.
We just think it's a great way to go about retirement, and it gives you that peace of mind and confidence that you can enjoy your retirement. And that's what it's really all about.
Yeah. At the end of the day, money is a tool. And we want to, sharpen the tool that you have as best we can so that you can enjoy your retirement, like Darrin's saying.
Yeah. All right. If you liked our episode and like what we're talking about, please hit that like and subscribe button.
Yes.
That helps promote us and get our outreach to more and more people, so we can spread the word about, these important retirement planning concepts. Also, check out our website, ewadvisors.com, and follow us on social media. We'll put those links in the show notes as well. And here's to a great 2026. Yeah. I will say this: the more you plan and the more you prepare, the more confident you're going to feel. Yes. And that is so important. You can't put a price tag on having confidence, knowing that you've dotted all your I's, crossed all your T's,
right,
and you've done the best you can. So,
yeah.
All right. Thanks, everyone, so much. And looking forward to catching you on our next episode.
See you guys next time.
Thank you for listening to the Retirement Planning Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or you want to have a holistic wealth and health financial plan, please visit our website. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors. PCA is an SEC registered investment advisor with its principal place of business in the state of Ohio. Evergreen Wealth Advisors and PCA are separate non-affiliated entities. PCA does not provide tax or legal advice. Insurance offered through Evergreen Wealth Advisors are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information pertaining to the registration status of PCA. Please contact the firm or refer to the Investment Advisor Public Discourse website disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the discourse statement carefully before you invest or send money.